Yes, sir. Hello and welcome to Easynomics at Business Today. I'm Siddharth Zarabi, and with me today, three of India's foremost economists and commentators who are now going to tell us about what the Monetary Policy Committee has done in the most recent rate hike decision that they have taken. Aditi Nayar, Chief Economist of ICRA, Madan Sabnavis, Chief Economist at the Bank of Baroda, and Madhavi Arora, Lead Economist at Emkay Global Financial Services with us. Welcome to the show. Madan, I'm beginning with you for your first comments about a 50 basis points hike in line with most expectations, but what struck you as the most important feature of the policy announcement?
Actually, in terms of the rate hike, I think what was significant was when the governor started off with his statement saying that there have been three shocks. I mean, COVID was known, but he has actually spoken in terms of the rate hikes by the Federal Reserve and other central banks as being the next kind of a shock which the world is going through. I think that is fairly significant because if we actually go back and see what the Federal Reserve had actually indicated in the last policy, they've actually spoken of more aggressive rate hikes in future. So that actually gives us a feeling that maybe this 50 basis points hike in the repo rate is not the last one, and there could be more rate hikes which could be around the corner. So if you actually juxtapose this with the OIS rates for 1 year, we realize that it's in the region of around 6.75. So I could actually extrapolate this 50 basis points and say that probably there could be another 50 to 60 basis points increase in the repo rate by March. That would be my initial reaction.
Okay. Aditi, that very same question to you.
So I have a slightly different view, Siddharth. I saw the overall policy document and the governor's statement as having a very neutral tone and actually indicating that there's going to be a lot more data dependency going forward. And by setting aside the aggressive policy action and the very aggressive tone of the global central banks as a shock, I actually interpreted it as the RBI and the MPC wanted to look more specifically at our own data, especially on inflation going ahead, and taking a cue from that. So I'm not sure we're going to be in for as much as another 85 basis points of rate hikes as what the OIS curve would be indicating. I think the extent of rate hikes going ahead will be muted and very, very data dependent in terms of the timing.
Okay. Madhavi, coming to you now.
Well, actually, I would probably take a more, I think somewhere in the middle stance, wherein I agree that, the world order has changed significantly in the last 2 months or so. In fact, when you talk about the supposedly balanced RBI tone, which was pretty similar to what we saw in August as well, I think a part of that was essentially driven by the fact that the world was in a more complacent and a more calm state as far as asset classes were concerned. And thus that led to RBI sounding relatively more balanced in the August minutes, which is what is even reflected at this point in time. Even though they have sort of raised rate by 50 bips, my sense is that they chose to, hike much more than some people who are expecting around 35 bips, is essentially to ensure that the asset classes domestically are not hammered by what is happening by the rest of the world. And to that extent, I think the front loading sort of justifies the fact that policymakers are somewhere tied to the Western way of managing their current dynamics as far as monetary tightening is concerned. And the world is essentially getting more and more strong down by what the Fed is doing.
Madan, for the consumer, Indian consumer, what does this 50 basis points hike translate into?
So as a consumer, I think you can be a borrower, you could be a depositor. And I think if you're a deposit holder or other saver, I think this could be probably good news for you because we have seen that deposits have actually slowed down because growth in deposits has slowed down because of the low rates which are being provided. And even today, when we're talking of 50 basis hike in repo rate, I think banks would be probably selectively increasing their deposit rates depending upon the maturities which would be relevant to them from the point of view of ALM management. So it may not be all encompassing. And at the same time, we have seen that even if we increase by 50 basis points, probably a deposit rates may not go up by more than say 20, 25 basis points. So we will not be seeing 100% transmission. But if you're a borrower, especially for mortgages, I think where the rates are linked directly to an external benchmark, in most cases, it's the repo rate. I think we are looking in terms of 50 basis points automatic transmission, which takes place. So loans are going to become more expensive. But the question to answer here is, will this deter people from borrowing? The answer is probably no, because whenever you take a home loan, it's for a period of, say, 10 to 20 years. And during this particular phase, there will be periods when interest rates go up and certain times when they come down. And everybody's aware of the fact that from 2020 onwards, for rather unusual times when interest rates came down to an all-time low. So that is some kind of a correction which was very much expected. So I don't think that will come in the way of growth in credit, but definitely it will improve. It will increase the cost for borrowers. The AMIs will get protracted.
Aditi, what is the broader macroeconomic impact, especially on the growth impulse? We are already seeing North Bloc in some ways send out a signal by reducing borrowing by what would be a token amount considering the size of the borrowing, which is 10,000 crore. What's your reading of the fine print as far as growth impact is concerned?
So overall, quite interesting. We'll get some updated fiscal numbers later today. But if we look at what happened with the borrowings yesterday and the very small increase in just a few small savings schemes, my sense is that the government seems to be more confident on the revenue buoyancy, and they seem to be quite confident that they'll be able to absorb the expenditure increases in the fertilizer and food subsidy, as well as the excise cuts which have already been effected, with possibly some modest savings coming in from some other heads as well. Now, in terms of the MPC, there was a large undershooting in Q1 growth as compared to the MPC's estimates. And that has led them to reduce their growth forecast for this year to 7% from 7.2%. However, they've actually increased their forecast all the way from Q2 of FY23, which is the quarter that's ending today, all the way up to Q1 of FY24. So they do seem to be somewhat more optimistic about the underlying growth momentum than was the case a month and a half, 2 months back. And also we had the word stable.
And what do you, just to interrupt you, why do you think they are optimistic at such a crucial juncture?
See, first of all, there is this really robust momentum that we're seeing in services demand. Secondly, we expect government spending to pick up, particularly the capital expenditure, to really pick up in the second half of the year. And we had a very interesting double data point today. We had the normal capacity utilization figures, the way that we've seen them. And we also had a seasonally adjusted capacity utilization figure, which shows that on a seasonally adjusted basis, capacity utilization was higher in Q1 as compared to Q4. Now, broadly, between the trends that we're seeing, the confidence level that we are seeing, some amount of sort of back to business as usual after the sudden shock created by the Russia-Ukraine war, we do think that capacity expansion will pick up toward the end of this year. So there is an underlying momentum of growth which seems to be stronger. We had a very strong GST e-way bill data for the month of August, which suggests that companies think that the festive season is going to be strong as well. And therefore, this, all leads to there being positivity for the second half of the year, even though on a year-on-year basis, growth is going to look like it's coming down because of the base effect. But having said that, if we compare to pre-COVID levels, we do expect growth to strengthen in Q2 as well as in H2. And we are actually maintaining our growth forecast for this year at 7.2% because we think that the actual outcomes will be better than even the revised forecast from the MPC.
Madhavi, let's stay on growth for a moment and move beyond the immediate rate hike discussion. Earlier, a few days back, we ran a story here at Business Today TV saying, where are the sales? And it's the 5th day of the Navratra, and all three of you will agree with me that at least on an anecdotal basis, I do not see that much of a bumper festive sales environment. Of course, there is perhaps a little bit more time left till Diwali. Am I correct in reading that and then adding the question that are companies who have a sort of ear to the ground picking up better consumption impulses than people like you or me?
Those are again anecdotal evidences. Of course, data is yet to reflect that. But I agree with you that there hasn't been any structural change in the growth dynamics per se. If I look at the real wages for both rural and urban sector, especially for urban, because we had heard enough noises in the post-pandemic period that the organized wages are actually, seen a big surge, especially led by IT and PFSI sector. But even if you see the, wage cycle since 2000s, this is, I think, the shallowest cycle in terms of, adjusted CAGR basis. So I don't think that the real wages actually have even picked up on a sustained basis in the urban sector, and they also seem to be now fading. More importantly, the real rural wages, so anyway, have been, sort of very sideways to weak, if you smoothen the uptick that you saw in the recent months or so. But on an average, I think the labor market doesn't seem to be exuberating the kind of excitement that one should expect when it comes to consumption, but because consumption eventually is a function of how the household income is evolving. So to that extent, I don't think the consumption story has changed for good. It's probably going to be a seasonal uptick, which you would see, which even the Reserve Bank also mentioned in the press release, that the second half is generally buoyed by the consumption side of the economy. Both urban and rural would do well, which also I think should be seen in a more negative front, because to the extent that India's growth story looks to be resilient vis-a-vis the rest of the world, and again driven more by the consumption, in some way or the other, the pressure would be reflected in the current account deficit and probably a longish inflation cycle in general. I'm not talking about prints in the immediate run, but generally, if a higher demand is seen as impacting your intrinsic demand or core inflation rather, to that extent, the reflection of that would be visible on your current account as well as on a probably more longish inflation cycle versus the rest of the world. So I think it comes with its own cost, which also has to be borne in mind when you're talking about India being an outlier in growth and the private consumption story being looking robust, at least on papers.
Madan, the world seems to be in a post-COVID turmoil, and no one had perhaps, or just very few people might have anticipated the kind of inflation pressures that we are seeing across the world. We also did not expect, at least I didn't expect, the pound crash trending as a headline on social media. Contrast the global situation with the Indian situation for the average viewer who would like to understand whether India has truly decoupled from the rest of the world at this point of time.
We have decoupled when we look at the real economy. When I say real economy, when we're talking of intrinsic growth, when you're talking of the 7% number, definitely there is a bit of decoupling which takes place. Primarily, it's not actually a very good thing to happen, because I would say because we are a very closed economy, a domestic-oriented economy, where growth comes because of domestic production, not really from the external side, that is exports. So that's been a kind of an advantage for us. So that's one of the reasons why we have been decoupled. But if we're looking in the monetary side and the monetary sphere, if I look in terms of what's happening to interest rates, what's happening to inflation, what's happening to investment, currency, I think that's something which we cannot really escape. So today, a large part of what we're seeing, the volatility in the currency market, what we're seeing also at times in the bond market, is a reflection of what is happening globally. So I think that kind of decoupling has happened only in terms of real production, but not in terms of the monetary indicators. So I think that's what the true story is, that I think even during the Lehman time, we took a lot of pride in saying that, look, the whole world has collapsed, the developed world has collapsed, whereas India, China, the other BRICS nations, we are also much better, we are greater, and we have decoupled. So it's basically because that integration is not there on the export side. Even today, we struggle to push our exports, and even if the rupee depreciates, we really don't get that kind of advantage. The global economy slows down or picks up, then we see there's some kind of traction in exports. So that is going to be positive for us, and I think it's good for this particular phase. We are still trying to get out of the lockdown-induced negatives.
Madan, before I go to Aditi, a quick comment from you about what has the RBI said and done about the rupee, again for the viewer, in a simple manner.
So actually, what actually came as a surprise to me, Siddharth, was that the RBI mentioned that out of the $50-60 billion, which forex reserves have come down since in the financial year, 67% of that was on account of valuation. So the valuation is essentially because we are holding the reserves not necessarily in dollars, but also in, say, pounds and euros, and maybe the yen and the yuan. And on account of the dollar strengthening, I think a large part of our reserves have gotten revalued. And that's how we have seen a lower number out there. So that gives a lot of comfort to us. The RBI otherwise has not provided any indication about what it feels about the right value of the rupee. It said very clearly that what it's concerned about as a central bank is volatility. So if they see there is too much of volatility, there will be intervention. They have not specified what kind of intervention will be there. Will they be in the spot market, in the forwards markets, NDF? Nothing of that sort has been mentioned. But it's only given comfort saying that a large part of this reserves coming down and people getting a bit worried saying that, look, the import cover has come down. Now what's going to happen to India? That may be a bit exaggerated, because if my reserves are coming down because of valuation, I think it's less of an issue when we're talking in real terms of what's happening to the external account than in case it was because RBI actually sold $60 billion to protect the rupee.
Aditi, would I be right in flipping this point around to say that given this bit about the change in the valuation due to what's happening in the overall foreign reserves basket, the RBI has spent less than what we believed it has spent to defend the rupee, and therefore the RBI is letting the rupee find its own level, whatever it may be?
Okay, so let me just sort of add from what Madan said. So one, the RBI governor talked about intervening in terms of volatility, but he still mentioned the words anchoring expectations. And of course, the whole commentary about the extent to which the fall in reserves has been because of revaluation. What I believe is going to happen going ahead is that between continued, although moderate intervention by the RBI, and the comfort that the markets will take from the extent of reserve fall that has been led by the revaluation of assets, I think there will be a more gradual adjustment in the rupee to a new market determined level going ahead, because we can't wish away the fact that the dollar index is very strong. Secondly, I do think that if the euro and the pound continue to fall against the US dollar, then we're probably still going to be in for a phase of continued downward revision in the foreign exchange reserves because of the revaluation. So that's something that we'll have to live with, but we'll have a better understanding going ahead that it's the revaluation which is causing the weekly numbers to come down and not necessarily intervention from the RBI. So I think it's comforting in some sense, but I think we should be prepared that the rupee will continue to show a gradual adjustment in the months ahead.
Madhavi, the question to you now. The extent of imported inflation that we've been seeing, what do you expect will happen over the next 3 months, and how does the overall inflation dynamic play out? Again, anecdotally, there seems to be signs that certain sticky areas of inflation have perhaps stabilized.
Yeah, so I think what will happen going ahead is that the imported inflation aspect probably will move away from cost of goods to actually the much sharper adjustment in the INR front. So it'll start flowing from the exchange rate pass through rather than the actual imported cost of goods, because to a large extent recession would lead to further correction in input cost of goods globally, which has also already been played out. The goods inflation globally is coming off. The producer prices are coming off. Ex energy, of course, I'm talking, and that essentially probably could be countered partly by the fact that rupee, as both of them had mentioned, rupee probably has a further leg to go down, and that itself would sort of become more inflationary from an incremental point of view. But that said, the exchange rate pass through of INR is not as strong, versus the input cost inflation that we're getting from the rest of the world, assuming rupee remains constant. Because even with a 5% depreciation in the rupee from here on, the actual inflationary impact would be not more than 20 bips, because I think around 12-13% of our CPI basket is, having a direct import exposure. So to that extent, the exchange rate pass-through mechanism is not as robust. even though it is obviously material at the margin as we go ahead. So inflation going ahead, in the near term, it could still remain sticky. I think we are tracking around 7.15 or 7.20 in the coming month for inflation. But as we move into the next quarter, I think we are most likely be going in line with the Reserve Bank. Our average inflation for the year is around 6.5% as against 6.7% from the RBI, so not much of a difference. In this volatile world, 20-30 bips really do not really count as such. So I think pretty much in line with the Reserve Bank. By end of the year, we should be sitting with somewhere close to 5.3% inflation.
Okay.
It's also partly because of the base effect. But of course, there are uncertainties around which could keep inflation sticky, and also the fact that we are looking at a much more robust consumption story back home, and services obviously has rebounded very sharply.
Right.
So I think the core inflation story could anyway remain sticky for us in the near term. But the global narrative clearly is that this inflation will come in one way or the other. If not in a very linear fashion, then in a probably much more non-linear fashion. But I don't think there's any debate in the world that this inflation is, coming our way sooner than later. That of course will be a function of how fast the
Right.
recession really plays out. But
Right.
that obviously will have implication for input cost of goods for us, assuming that rupee remains, stable.
Madan, how do you read the crude oil situation? That is one of the most important elements when it comes to inflation pressures in India, and there has been the protection of the retail consumer by the government at the cost of the oil marketing companies. At some point, that account will have to be settled, but we'll leave that for another debate. But your own reading of crude oil, the inflation dynamic, with one final point. Just a few days back, Sanjeev Sanyal told me that, in his view, inflation has peaked in India.
Oh, sorry, I didn't get that part. Inflation has peaked.
Yes.
Yeah,
Yes.
I think it looks very likely that inflation has peaked. I think the only caveat will be that if we have an onion and tomato inflation because of a bad crop, that could actually spoil the numbers. But in terms of crude oil, I think the RBI has been fairly conservative in terms of its estimate for the second half of the year. And because I think the critical part is on account of the natural gas problem, which is there for the European region. In case there is any kind of a switch to oil, I think that's something which could spook up the prices again. So I think that will always remain an unknown quantity about what happens to crude oil prices. Today, they are in the region of around $90 per barrel, which gives a lot of comfort to the entire world. But this could actually move up beyond 100 in case something does go terribly wrong in terms of, again, the dynamics between Europe and Russia. So that's something which one would be looking out for. But internally, I think it's more of a political decision about what to do to the retail prices. And you're right. Right now, what's happening, it's all a game between whether I pay it or whether the ONCs are paying the same thing. Or probably from the point of view of the government, they'll say that the extra tax which they're putting on the oil companies. I think it's just a case of how we are meddling with these particular numbers. But to my mind, I think the government may not do anything at this point of time to increase the prices, because that's what finally, crude oil price doesn't really matter. It's a conscious decision taken by the government, which could push up inflation in case there's any further revision which takes place in the price of fuel products.
That point to you, Aditi, as we wrap this conversation, the inflation dynamics that you expect are going to influence both monetary policy as well as fiscal policy, at least in the next 2 quarters.
On the crude oil front, I completely agree with Madan that it's more prudent to assume that crude oil prices will go up as we're entering winter in the northern hemisphere, given the kind of geopolitics that we're still in. We are also expecting crude oil to be in a range of $90 to $110 per barrel in H2, and I think the RBI taking 100 as the baseline forecast is a very prudent decision. I also agree with Madhavi that we're actually also forecasting the CPI inflation to be slightly lower than what the MPC has held on to today. We have a figure of 6.5% as well. And agriculture, in the Indian context, food products, that's always a risk that we seem to face. And every other year, at least we have some sort of food shock that pops up. So we can never wish that away in the Indian context, at least as of now. And one more thing that we're looking out for is what kind of service inflation numbers we start getting going ahead month on month, because that's really where we see growth being very, very strong. And also agree completely, the imported component of the CPI is quite small. Almost half of the CPI basket is food, another quarter is services. So these are all largely domestically oriented. So while there is a very quick transmission of the INR depreciation to the WPI basket, it's not that quick and it's not that strong to the CPI basket. So from the MPC's point of view, rupee depreciation going ahead may not be the primary factor that is going to feed into their inflation assumptions. And therefore, it's still going to be sort of two separate decisions in terms of what is the monetary tightening that is appropriate given the domestic inflation growth dynamics, and what is the broader context in terms of what's happening with the rupee, etc., and where the RBI is comfortable letting the rupee slide to and adjust to going ahead.
Okay, Madhavi, I'm going to request you for a yes or no answer if that's possible on the question that I'll ask. But is the world slipping into a recession? Minus India, of course. What would you say?
No, I think policy makers at this point in time are clearly engineering one. The kind of sharp repricing that you have seen for the US Fed and even other developed markets who are actually seeing visible signs of the risk, especially Europe. It definitely reflects the fact that at this point in time, the domestic stability in terms of inflation dynamics, seems to have overridden everything else for them. And
so what are the chances?
Inflation trade-off is.
What are the chances if you were to?
There is going to be a very sharp slowdown. I don't know how long it would last because there are buffers at this point in time as far as the global, or rather the US economy is concerned. But I think we are in for a recession maybe mid of next year is what I'm pricing in, assuming that Fed is able to reach its terminal rate by early part of next year. So an average recession of around a year or so.
Okay.
And I think more than 70% probability.
70%. Okay. Aditi, very quickly before I go back to Madan for the last point on that, what's your own sense on the recession question?
Being engineered by the US and completely being driven by energy prices in the UK and Europe. So high likelihood that we'll have a recession. And how long it will last will depend on how quickly commodity prices correct and central bankers take the foot off the monetary tightening pedal.
Madan, the very same question to you.
I would say less than 50% because I think even central bankers are intelligent people, and the moment they see it going towards a negative zone, they will remove the foot from the pedal.
Okay, 2 out of 3 very clear answers, and Madan being optimistic, but it's always good to be optimistic when you have dark clouds on the economic front. As always, thank you very much for your time. That was Madan Sabnavis, Aditi Nayar and Madhavi Arora talking about all matters economics. If you've been watching Easynomics, thank you very much for your time. We'll be back with more. Till then, goodbye.